A revolution is taking place in the world of investment funds, and in Europe, UCITS funds that are too expensive will be removed from the market very soon. In this video, we packed the latest regulatory intelligence on the value for money rules and how to keep costs down without compromising market presence for your UCITS. In November 2024, ESMA launched very quietly a data gathering exercise on the cost of investing in UCITS and alternative investment funds. Data on UCITS costs and fees is collected as part of a broader plan to introduce value for money rules in Europe. And the European version of value for money is unique because it adopts a data-driven approach and provides for the development of European price benchmarks. The principle in Europe remains that investments that offer the same performance should cost investors the same, and benchmarks are introduced to help European authorities when assessing whether specific UCITS provide value for money to their investors or not. For each asset class or strategy or combination thereof, benchmark will give an indication of the average cost profile of a fund. Benchmarks will be used to identify outliers, and these are funds with a cost profile that is divergent from the category identified within the benchmark. These funds will have to justify that they can provide value for money notwithstanding the higher cost profile. Value for money rules in Europe also grant powers to supervisory authorities to ban from the market UCITS that cannot justify the high fees. And regulation is not final yet, so we cannot have a definitive view of the full extent of the powers that will be granted to supervisory authorities in this respect. But the writing is on the wall for all the UCITS that are too expensive to run. That is a fact. The European architecture of value for money could not be complete without a notion of undue costs. European regulators started to take a close look at the costs associated with retail investment products already in 2020, and that was when cost and performance of retail investment products were identified as a strategic supervisory priority in the European Union. ESMA spearheaded the movement against undue costs of UCITS, which resulted in a briefing first in 2020 issued to guide national competent authorities in their activities of supervision of costs. Then there was a common supervisory action in 2021 to ensure that fund managers were not charging undue costs to investors. Common takeaway from these exercises was that the lack of a definition of undue cost was hindering prevention and enforcement activities of supervisory authorities. And the approach of European authorities for what concerned the notion of undue cost turned out to be prescriptive but not dissimilar from the one adopted by other global regulators. A notion of undue cost will be introduced both under the UCITS and IFM directives, and this will be defined by contrast with costs that are deemed due. Under a reform proposal of the UCITS Directive, costs will be deemed due if they meet three key criteria. First, they align with disclosures made in the fund offering documentation, including retail disclosure. Second, they are necessary for the UCITS to operate in line with its investment strategies and regulatory requirements. And third, they ensure fair treatment of investors, meaning the cost must be proportional to the value provided. Sector studies demonstrated that UCITS distributed cross-border in Europe tend to be a little more expensive than the one distributed only in a couple of host member states in Europe, and that is due to the portion of the ongoing cost dedicated to cover costs and fees related to marketing UCITS cross-border in Europe. Entering a new market adds costs related to registration, appointment of facilities agent, translations, ad hoc disclosures, notification and supervisory fees, as well as costs related to the creation of new share classes to accommodate for currency requirements of local investors in certain European member states. UCITS marketed cross-border in Europe might be more expensive, that's true, yet they stand a better chance to grow their assets under management over time, and this is because they have exposure to an increased audience of investors by marketing in multiple markets across Europe. Another point to consider is that the higher the AUMs, the lower the impact of certain fixed costs which are part of the equation, like administration costs, depository costs, legal, regulatory, you name it. And the cross-border distribution directive introduced a few years ago aimed exactly at reducing some of the costs incurred by UCITS funds marketed across multiple countries in Europe. Despite the potential, not many UCITS managers have fully embraced and implemented yet the cross-border distribution Distribution Directive in their operations. With the increased focus of European regulators on costs of UCITS, we expect the trend to change very rapidly over the course of the coming month, with managers scrambling to cut some of the running costs of their funds and making more efficient the operations dedicated to UCITS European distribution is something that managers should have looked at already. But where do the easiest opportunity lie for cost savings for all the UCITS distributed cross-border in Europe? One area that has been overlooked so far is Article 92 UCITS Directive, recently amended by the Cross-Border Distribution Directive. Article 92 UCITS Directive provides that UCITS marketed in host member states must make available facilities to local investors, and that entailed so far that a brick-and-mortar agent, most typically a local credit institution, was appointed in each host member state of distribution. And the new version of Article 92 UCITS Directive now opens to the option of making available these local facilities digitally to investors by means of a website, and the only condition really is that the facilities are offered in the language of the host member states. Until now, appointing brick-and-mortar facilities agent in each host member state was expensive, but the ability to digitalize the provision of local facilities allows to slash significantly a portion of the costs related to UCITS European distribution. And if that wasn't enough, given that appointing a physical facilities agent is no longer required to comply with the UCITS Directive, related costs may also be deemed undue very soon. And while the Cross-Border Distribution Directive brings about cost savings opportunities, it's not all smooth sailing for UCITS distributed cross-border in Europe, because the same directive comes also with increased compliance requirements, which will impact the ongoing cost. We are referring to Article 93 UCITS Directive, which imposes notification of changes to the information provided as part of an application for marketing authorization of a UCITS. And with a small simple change, the Cross-Border Distribution Directive now imposes that the notification of changes has to be made also to the home state authority of the UCITS and not only to the host member states. With that comes, of course, an additional burden of having to prepare an amended notification letter for each and any change, an increased administrative burden, which inevitably translates in additional registration costs for UCITS that are distributed cross-border, and this fall under the bigger bracket of registration costs. But also here technology is helping to slash costs, because there exists smart digital solution that can assist managers in complying with this new notification requirement in a more efficient manner, automating exactly that part of the process that is related to the drafting of these notification letters and the submission packages for the notification of changes. If you made it up to this part of the video, I wanted to thank you and remind you to hit like to this video and subscribe to the channel. There is a lot more to come on European distribution and how we can help to increase your market presence and reduce your cost. Thank you for watching. Stay tuned.